Banks, as we know, are in transition. Just a few minutes ago, we were talking about this week's earnings and what they mean for the industry, what they showed us about the industry. Well, our next guest, says new regulation is going to limit moneymakers like the prop trading desks and the derivatives business. It might end up reminding us of old-fashioned banks, the ones that relied on spread lending to make money. That's why Gary Shilling says it is time to avoid investing in regional and major banks. Gary's the president of Gary Shilling and Company. And a welcome guest on the Inside Track. Gary,
not a new guest.
Not a new guest, no. He's been doing this for longer than we have, Sara. Gary, you put out this monthly report in which you recommend certain things. You're bullish on treasuries. You're bullish on the U.S. dollar, have been for a long time. You say sell U.S. major and regional banks. Is the outlook for this industry so bad, in your opinion, that there's no point holding them at the prices they're trading at now? And I should remind everyone, they're pretty depressed from where they were not so long ago.
Oh, they are depressed, but of course, if we went back 2 months ago, they looked cheap. And, as a friend of mine says, they get cheap, cheaper, cheapest, and then you sell. I mean, the whole point is that they're under extreme pressure. And as you just outlined a minute ago, Erik, they started off with all kinds of very profitable but highly risky businesses, derivatives, in off-balance sheet activities, and proprietary trading. I mean, you look at these huge trading desks, UBS up in Connecticut and so on, and you say, are those guys really are they really that smart? Or is this just huge leverage? Well, I figured out years ago it's really huge leverage, but that means risk. And they obviously are being bereaved of these things and busted back to spread lending. Now, spread lending is okay if you have a steep yield curve, a big difference between the rates at which the banks borrow and the rates at which they lend. But guess what? The yield curve is not only flattening, but the Fed's Operation Twist is, in effect, flattening it further. So they really don't have much spreads, and overall loan and lease volume is flat. So you can't make it up on volume.
Well, Operation Twist isn't going to last forever, though, Gary. I mean, you're a deflationist. I know you think we're heading into a deflationary period, but at some point, inflation is going to pick back up. The yield curve is going to steepen. And spread lending, even if that's the only business these banks are allowed to be in, and I have to say, I'm a little bit skeptical about that. I think they're going to be able to do a few more things, but spread lending will be a good business again.
Well, forever's a long time, Erik. Like you say, markets can remain irrational a lot longer than I can remain solvent. But the whole point is that this thing could be stretched out. And in the meanwhile, while you have the situation, you have the downside risk, the spillover from Europe.
Yeah, I was just going to ask you about that, because not only are they dealing with the Fed here as a risk and the yield curve, but there is this major sort of question mark. We don't know exactly how it's going to hit the U.S. banks, do we?
If you look at U.S. bank total global exposure, 27% of it is in the Eurozone, and if you throw in the UK, it's 54%. In other words, you have a massive exposure, and of course you have all the situation of, particularly with derivatives, the counterparty risk. Is the counterparty really going to make good, and so on. Now, I think the European banks are going to basically be bailed out by the governments, just like we bailed out the banks in 2008. I mean, governments just, too big to fail means, yeah, you are too big to fail. But
Gary, remember, we bailed out the banks in 2008, and then banks turned into a magically fantastic investment.
Well, they did. But I'm just saying, what is the transition problem? What goes on in the meanwhile? Because banks turned into a great investment from a very low basis. When you get Citi down to $1 a share, from where did it start out, $40 or whatever? I mean, yeah, right.
The volatility that we've seen in U.S. banks, Bank of America, Morgan Stanley, coming from Europe, have we seen the worst of it?
I don't think so. And again, it doesn't mean the European banks aren't going to get bailed out, but we haven't seen a major bank fail. Dexia is the closest we came, and of course they got bailed out by the Belgian and French.
Gary, do you believe the marks? I mean, when these banks, for example, tell us, as Morgan Stanley did yesterday, that their net exposure to Europe is $2 billion, and that if France were to go bankrupt, Morgan Stanley would actually make money. Do you believe those marks?
No, I really don't, because I don't think they're marking things to market. And you get really accounting gimmicks, like, for example, we've seen in the big bank reports in the last few days, where bonds they issue are underwater, so they count the difference between the underwater price and the issue price as a profit. Now that's
I mean,
an interesting.
even
That's
James
an
Gorman
interesting.
of Morgan Stanley calls it a bizarre accounting anomaly. If they didn't have to do it, I don't think they would.
Well,
be doing it.
maybe they wouldn't, but you know, and I'm not an accounting expert, but I do
More
have
of one than we are.
I do have a strong suspicion on this whole thing. And again, when you talk about net exposure, I think you got to look at gross exposure because again, you have counterparty risk in here. I mean, is the other guy going to make good on this thing? And if that's all the net exposure you have, why don't you wipe out all of the gross exposure and just get down to it? Why don't you cut out the middleman if you're really being honest about that? But they have reasons why they want all that gross exposure.
Gary, are you saying that the end game here in Europe is we're going to have to see a bigger bank fail than Dexia?
I think we probably are because Europe has, you know, you've got the Teutonic North jammed together with the Club Med South under one currency. And that's creating all kinds of problems. And the reason they're machinating now, not that they know they don't have to bail them out, but they really, the German, Merkel's got to bring her voters along. I mean, they're waiting for a crisis to force them into it. That's what politicians do for a living.
Gary, great to see you here on the Inside Track.